I want to ask you a question, and I want you to really think about the reality of the world we live in right now.
Okay, lay it on me.
Why is it that some isolated, totally resource-poor pockets of the world somehow control the absolute lifeblood of global technology,
Right.
while the vast, overwhelming majority of countries are just, they're suffocating in the mud of low-tier manufacturing?
Well, it is the defining economic paradox of our time.
Mm.
And the answer is completely contrary to everything we are taught about how success actually works.
Exactly. Welcome to today's deep dive. Because our mission today is to completely decode how a tiny country can just corner the global tech market.
Yeah, and we're looking at a foundational piece of research for this.
Right, from the National Bureau of Economic Research, the NBER. It's a working paper by Professor Assaf Razin called High Tech and Venture Capital Inflows, the Case of Israel. And let me tell you, this paper it rips away all the romanticized stories we like to tell ourselves.
It really does.
Yeah.
Because, we love a good story. We want to believe that innovation is this pure meritocratic thing.
Right, the guy in the garage.
Exactly. We want to believe that if a country just has enough smart people, enough plucky entrepreneurs tinkering away, it will inevitably rise up to become a tech superpower.
Or that a government can just endlessly throw subsidy money at, university labs and boom, you get the next Silicon Valley.
Yeah, but the NBER report reveals a fundamentally different reality. It reveals a highly mathematical, totally unsentimental, and honestly ruthless logic.
It forces us to look at the unvarnished face of global capital.
And that reality is going to be a slap in the face to a lot of people. Because the secret to becoming a tech powerhouse isn't just about having local geniuses.
No.
The secret is a very specific, highly demanding form of foreign intervention.
So let's start right there, because we need to shatter the biggest misconception out there, the myth of the homegrown genius.
Oh, it is arguably the most pervasive economic myth we have today. And the data just completely dismantles it.
You're saying that an isolated small economy simply cannot be a global center of innovation, no matter how smart its people are?
It is structurally impossible. It simply does not have the capacity. Let's separate the romantic idea of invention from the brutal economic reality of innovation.
Okay, what's the difference?
Invention is just having a brilliant idea. A guy in a garage can have an invention.
He builds a prototype, it works, he's a genius.
Right. But innovation is taking that brilliant idea, surviving an incredibly expensive gauntlet of failure, mass producing it, and then embedding it into the global economy.
Wow.
And a small, isolated country simply cannot provide the ecosystem for that second part.
So wait, even if a small country is practically overflowing with geniuses, let's say they mathematically have the highest IQs on Earth, the best engineers, the absolute best coders.
Doesn't matter.
If they are isolated, you're saying their innovations are literally going to die inside the laboratory.
They will expire in the petri dish.
Yes.
Because the economics of isolation are just totally unforgiving.
Okay, let me test an analogy on you to make sure I'm really grasping the mechanics here.
Go for it.
Imagine someone builds the most incredible billion-dollar state-of-the-art roller coaster.
Yeah.
It defies gravity, it's an absolute marvel of engineering, but they build it in an isolated town with a population of 10 people.
Right. I follow you.
It doesn't matter how mind-blowing the ride is, right? The upfront cost to build it was $1 billion. Those 10 local people buying tickets will never, ever cover the cost of the steel.
Let alone the daily maintenance.
Exactly, the electricity, the insurance. Without millions of tourists, without a massive external influx of people and capital, you go bankrupt, and that beautiful roller coaster just rusts into the ground.
That analogy captures the exact mechanism perfectly. You are talking about economies of scale.
Right.
An invention might cost nothing to dream up,
Right.
but the infrastructure to monetize it costs a fortune. If your customer base is capped at 10 people, the math simply doesn't allow the project to exist.
Which brings us directly into what we can call the innovation death trap.
Yeah, which is an incredibly expensive, highly risky gamble. Look at Israel in the 1970s. It was essentially a low-income, developing economy. It had an agricultural base, some low-tier manufacturing, high inflation, and most importantly, its domestic market was microscopic.
Right. Tiny population.
Utterly incapable of absorbing the astronomical upfront costs of R&D.
Because R&D isn't just paying one smart guy to sit and think. It's building the lab, running 1,000 failed experiments.
Paying for materials that just get destroyed.
Exactly. Writing code that crashes and has to be rewritten from scratch. The upfront sink of capital is enormous.
And that brings up the concept of the repeatability factor, which this NBER report really highlights. Innovation relies entirely on repeatability.
Meaning?
If an entrepreneur cannot mass produce their technology and repeatedly sell it to the entire world, they won't even have the incentive to start the project.
Because they've already run the numbers in advance?
Exactly. The expected return is negative before they even turn on the lights in the lab. If you're going to spend $50 million developing a revolutionary piece of enterprise software, but the maximum total revenue you can extract from your small local market is $5 million.
You just don't do it.
You don't. The project dies as a thought experiment.
So the natural pushback here, right? What you always hear is, well, why don't they just get investors?
Right.
If the idea is good, go to Wall Street, issue stocks, get normal, everyday portfolio investment to fund the prototype.
And this is where the logic of the global market becomes very, very specific. The report is clear on this. Normal, everyday Wall Street stock market money, what economists call portfolio investment, cannot break this deadlock for a small developing nation.
Well, why not? Money is money, isn't it?
Because portfolio investment is inherently passive. It is money looking for a return on a spreadsheet. A mutual fund manager in London buying shares in a foreign company doesn't have the patience, the operational expertise, or the sheer force of will to drag a nascent, buggy technology out of a small market and force it onto the global stage.
They just want to see the quarterly earnings go up. They aren't going to roll up their sleeves and help you build global distribution channels.
Right. So you have this situation where the local market is too small to fund the innovation, and standard global investors are too distant and too passive to scale it.
It really makes you wonder, I mean, how many brilliant ideas historically just vanished into thin air?
Oh, thousands.
How many medical breakthroughs, how many revolutionary energy designs just evaporated because the local market couldn't fund the prototype phase and the global market just didn't care?
Human history is undoubtedly a graveyard of brilliant ideas that lack the specific capital architecture to scale.
Which makes what happened next so fascinating, because we are looking at a period where things suddenly violently change. Let's talk about the 1990s. Because the data in Professor Razin's report reveals a bizarre anomaly.
It's one of the most striking macroeconomic shifts in recent history.
Let me describe this data for you listening, because it really paints a picture. If you look at the gross domestic spending on R&D as a percentage of GDP, from 1981 all the way to 2014, you see two distinct trends.
Right.
We have the OECD average, which is essentially the average of the wealthy developed nations of the world. And then we have Israel's trajectory.
And for the entire decade of the 1980s, there is nothing remarkable happening.
Exactly. From 81 through the late 80s, the developed world average is hovering around 2% of GDP going to R&D. Israel is right there in the mix, maybe slightly below, maybe a fraction above.
Just a totally mundane, flat trend line.
But then the 90s arrive.
And the geometry of the day completely breaks.
It shatters. That flat line for Israel suddenly turns 90 degrees upward. It goes completely vertical.
Yeah.
It rockets past 3%, blasts through 4%, and eventually breaks the 4.5% mark. Meanwhile, the rest of the developed world is just trudging along at that same flat 2-something%, completely left in the dust.
It's incredible.
You look at this data and you just want to scream, what on earth happened in the 90s? Who stepped in to fill this colossal multi-billion-dollar funding gap when we just established that local markets were too small and regular stock investors didn't care?
Well, to answer that, we have to look at how capital actually behaves when it senses an opportunity. We have to introduce what I would call the apex predator of the global financial ecosystem.
The apex predator. Man, that's a strong phrase. What are we talking about here?
We are talking about foreign direct investment, FDI.
Okay, let's unpack FDI. How is it different from the regular stock market investing we were just talking about?
Well, capital has the sharpest sense of smell in the world. While average retail investors in typical mutual funds were staring at stock tickers, trying to play the margins, giant, highly sophisticated pools of money were surging into Israel through this mechanism called FDI.
Okay.
The report shows that Israel was pulling in FDI, amounting to a staggering 4% of its GDP.
Wait, let's put that in context. What was the rest of the developed world pulling in?
The OECD average for inbound foreign direct investment was only 1.4% of GDP.
So Israel was pulling in nearly 3 times the average of the entire developed world.
Exactly.
But you said earlier that it's not just about the sheer size of the money.
It isn't. I mean, if it were just about a large volume of money, it would operate similarly to a massive portfolio investment. The defining characteristic of foreign direct investment is the power that comes attached to that money.
Power in what sense?
When a foreign entity engages in FDI, they're acquiring an asset in another country with a direct, explicit intent to manage that asset.
They want control.
They demand control. That management dimension is what fundamentally separates it from just buying foreign stocks or bonds. They are not placing a bet from afar. They're taking over the operation on the ground.
So to go back to the roller coaster analogy, they aren't just buying tickets, and they aren't even just investing in the theme park stock.
Right.
They are flying in, buying the entire theme park, firing the old management, bringing in their own engineers, and connecting the roller coaster to their massive global tourism network.
Precisely. They integrate the local startup into their pre-existing global supply chains. Think about what happens when a multinational tech giant uses FDI to buy a struggling but brilliant software startup in Tel Aviv.
Okay.
That startup is no longer trapped in its tiny domestic market. Overnight, its potential market becomes the entire planet because the multinational parent company already possesses the distribution channels, the marketing muscle, and the global client base.
Okay. That makes total sense from the startup's perspective. They get a golden ticket out of the innovation death trap. But I want to push back on the investor side. Why is this aggressive, hands-on, controlling approach so necessary? Why can't a venture capitalist or a multinational just write a massive check, stay in New York or London, and say, good luck, guys, send me a quarterly report?
Right.
Why go through the massive headache of trying to manage a company on the other side of the planet?
That is the pivotal question, and it leads us directly into Professor Razin's core economic model. He outlines what is known as the information asymmetry trap.
Information asymmetry, meaning one side knows something the other doesn't.
Exactly. Let's walk through the theoretical model of how this works in practice. It is essentially a game of blindfolds.
Okay.
When you have regular foreign investors buying stocks portfolio investment, they're essentially playing blindfolded. They are sitting thousands of miles away. They have absolutely no idea what the internal, ground truth, day-to-day risks of a foreign startup actually are.
Because a startup isn't a mature company like Coca-Cola. It's chaotic.
It is entirely chaotic. The code might be full of fatal bugs. The co-founders might be secretly at war with each other over the company's direction. The prototype that looked great in a controlled demo might be held together with duct tape and wishful thinking.
But the foreign investor only sees the polished quarterly report.
Right. And this distance, this fundamental lack of visibility, breeds a massive problem in economics called moral hazard.
How does moral hazard play out here?
Well, moral hazard occurs when someone increases their exposure to risk because they know someone else bears the cost of those risks. If a local founder knows that their investors are blindfolded and sitting in an office 6,000 miles away, that founder might start taking incredibly reckless gambles with the investor's money.
Give me a concrete example of what that looks like.
A founder might decide to pivot the entire technology platform on a whim without telling the investors, burning through millions in cash. Or they might start hiring all their friends at inflated salaries. Or they might just hide critical technical failures to keep the funding rounds going. They engage in behavior that severely lowers the probability that the investment will ever see a return, simply because they know the investor can't see what they're doing.
I'm picturing this as it's like lending your car to a complete stranger you met on the internet.
Yes.
You hand them the keys, they drive off, and you just have to sit at home and pray they don't drag race it into a brick wall. You have zero control, and they have no real incentive to treat your property with respect because it's not theirs.
That is the perfect encapsulation of portfolio investment in a high-risk tech market. Now, contrast that dynamic with foreign direct investment. FDI completely breaks this credit black hole.
Because FDI takes off the blindfold.
Because FDI buys control. They bring the massive capital injection, yes, but they also bring their own seasoned managers.
Oh, wow.
They put their own executives on the board of directors. They demand daily audits. They oversee the engineering protocols. The blindfold comes off entirely.
So, if portfolio investment is giving a stranger the keys to your car, FDI is getting into the passenger seat, strapping in, putting your foot over a secondary brake pedal, and constantly monitoring the dashboard. You are in the vehicle with them.
Yes. And because the foreign investor is sitting in the passenger seat, they can accurately value the project in real time. They completely mitigate the moral hazard because the founder can no longer hide failures or take reckless risks without the investor immediately knowing and intervening.
The report mentions something called a productivity shock in this context. What does that mean?
The productivity shock in the model is simply the actual realized potential of the technology.
Hmm.
Is it actually going to work and generate revenue? Because the FDI investor is intimately involved in management, they can accurately observe this productivity shock as it happens. This hands-on, aggressive management style makes the investment vastly more efficient and vastly more likely to succeed.
Okay, looking at it from that angle, it sounds like a flawless system. It's a perfect win-win.
It seems like it.
The tiny country gets the massive capital injection and the global scale it desperately needs to escape the death trap. The massive foreign investor gets to own breakthrough technology and entirely mitigates their risk by taking direct control of the asset. So, problem solved, right?
Not at all. And this is where the deep dive gets really intense. Because in global economics, there is no free lunch.
Right.
Letting this kind of aggressive, highly mobile global capital into your country invites a terrifying, truly fatal level of danger.
A fatal danger from the people bringing in the money.
Yes. When a country relies on FDI, it is dancing on the edge as a knife.
I have to admit, this is the part of the source material that really stopped me in my tracks. Because Razin introduces an economic framework, and it introduces a concept called the liquidity shock.
Yes.
Can you break down how this actually works? Because it sounds incredibly academic, but the implications seem brutal.
It is brutal. The model explains the hidden, severe punishment cost of foreign direct investment. Let's look at the mechanics. We just established that FDI investors have superior inside information because they are actively managing the company, correct?
Right. They are in the passenger seat. They see everything.
But that very advantage, the inside information, becomes a deadly trap for the host country if things go wrong back in the investor's home country.
Wait, how?
Let's walk through a scenario. Imagine a massive venture capital firm based in New York. They have poured $50 million into a direct investment in a highly promising Tel Aviv software startup.
Okay. The technology is coming along great. Everyone is happy.
But suddenly, the New York firm gets hit with a liquidity shock.
What causes a liquidity shock?
It could be anything external. Maybe the U.S. stock market crashes. Maybe the firm's own institutional investors suddenly panic and demand their money back.
Like a sudden cash crunch.
Exactly. Or maybe a completely unrelated investment the firm made in another sector goes bankrupt. The point is, the New York firm suddenly, desperately needs cash right now to cover its own liabilities.
So they have a maturity mismatch. They need liquid cash today, but their money is locked up in an illiquid tech startup in Israel that won't be profitable for another 3 years.
Exactly. So what must the New York firm do? They are forced to sell their stake in the Israeli startup early, before the technology is even finished, just to raise cash to survive.
Okay, so they sell their shares to someone else. It's unfortunate for them, but why is that a fatal danger to the startup or the host country?
Because of the information asymmetry we discussed earlier. Remember, the rest of the global market knows that this New York firm is an insider. They know the firm has been sitting in the passenger seat, monitoring the dashboard, seeing the actual code.
Right.
So, when the global market sees this deeply embedded insider suddenly trying to urgently sell their asset at a discount, what does the market automatically assume?
Oh, wow. I see it. The market isn't going to think, oh, the New York firm must just be having a liquidity issue back home. The market is going to assume the asset itself is garbage.
Precisely. The market assumes the technology is a scam, or the code is fundamentally broken, or the founders are incompetent. Because why else would the guy who knows the absolute most about the project be running for the exits?
Even if the startup is perfectly healthy and the technology is revolutionary,
Yes.
the mere act of the insider trying to sell triggers this catastrophic assumption of failure.
Yes, it creates a lemon problem. The resale price of a direct investment plunges dramatically. It triggers a panic-driven fire sale. Buyers will demand a massive premium, a huge discount, to take on what they assume is a toxic, failing project abandoned by its management.
So the startup gets its valuation absolutely decimated, not because they did anything wrong, but just because their foreign investor had a bad day on Wall Street.
And if this happens across multiple firms during a global downturn, it can trigger a systemic collapse of the host country's entire tech sector. The capital flight destroys the economy. That is the nice edge.
Okay, I have a major pushback here.
Let's hear it.
If the penalty for pulling out early is complete financial ruin, if the market is going to assume your asset is toxic and force you to sell it for pennies on the dollar the second you try to liquidate, why would global capital ever feel safe?
That is the million-dollar question.
Right. Why would a New York VC ever leave their money in a tiny, geographically vulnerable foreign country, knowing that a liquidity shock could trap them in a fire sale? It sounds like putting your head in a lion's mouth.
That raises perhaps the most important point in development economics. Why do some countries manage to attract and hold this capital while others fail completely? Capital will only take that enormous risk if the host country has painstakingly built an institutional safe harbor.
An institutional safe harbor, which sounds very grand, but the reality is actually quite dry, isn't it?
It is incredibly dry. The solution isn't some flashy tax break for tech companies. It isn't a cool marketing campaign about being a startup nation.
Yeah.
The bedrock of a tech empire lies in the most unglamorous, boring foundational design imaginable. Extreme creditor protection.
Let's unpack the mechanics of that. How does the law protect capital from a liquidity shock?
The report cites compelling data analyzing 52 different countries over decades. And their data is unequivocal. The stronger a country's legal protection for creditors, the lower the probability of a severe stock market crash during a liquidity crisis.
Let me make sure I'm translating the legal jargon into reality. Capital doesn't just want smart engineers. It demands a legal fortress.
Yes.
It demands an ironclad guarantee that if the worst-case scenario happens, if the startup goes bankrupt, if the founder goes rogue, or if a global crisis hits and the investor needs to liquidate, the local legal system will swiftly, efficiently, and ruthlessly allow the foreign lender to take absolute control of the collateral.
Yes. Think about what collateral is in a high-tech startup. It's often intellectual property, patents, code. High-quality collateral only matters if the legal system allows you to seize it easily and sell it.
Because if the bankruptcy courts are slow, corrupt, or biased toward local founders, the foreign investor is trapped.
Exactly. Strict creditor rights regulation mitigates the panic of a liquidity shock. It sends a clear signal to the foreign investor. Even if there is a crisis, your downside is legally capped. Our courts will not protect local founders at your expense. You will get your assets back.
Wow.
By ensuring lenders can easily take control, the panic of the fire sale is neutralized. The market knows the investor can recoup value through legal liquidation rather than a desperate fire sale.
So this incredibly dry, boring, legal bedrock, these obscure bankruptcy laws and creditor rights statutes, is the exact reason why hordes of Silicon Valley venture capitalists felt perfectly comfortable flying to Tel Aviv and dumping billions of dollars into high-risk startups.
Precisely.
The law protected their money when the mathematical models couldn't.
You simply cannot have a high-tech revolution without a hyper-aggressive legal framework protecting the people funding it. Capital is cowardly. It will only flow where it is legally fortified.
Okay, so let's put the timeline together. Israel builds this legal fortress. The 1990s are roaring. The foreign direct investment is flowing in at astronomical rates. The tech sector is booming. And then the year 2000 hits. The dot-com bubble bursts.
One of the most destructive financial events of the modern era. Trillions of dollars of wealth wiped out globally in a matter of months.
Right. And here is where we hit a deeply counterintuitive, almost offensive fact. A fact that might feel like a slap in the face to anyone who lost their life savings in the 2000 crash.
Yeah.
If we look at the historical data in the report, specifically Figure 1, which tracks the trends, the lines for venture capital and foreign direct investment heading into the year 2000 are perfectly fused together. They are soaring into the stratosphere.
It was a period of total euphoria.
And then the bubble bursts. The global internet economy is devastated. But for Israel, the report argues that this crash wasn't just a ruin, it was actually the ultimate foundation. How is that mathematically possible?
To understand this, we have to look at the physical mechanics of a financial bubble. The dot-com bubble was a brief period of total irrationality. Purchasers believed that normal valuation standards, normal revenue multiples, no longer applied.
Right, they were throwing money at anything with a .com in its name.
But here is the paradox of bubbles. That massive irrational surge of money before the crash actually built the physical and human infrastructure of the future.
I'm trying to frame this mechanically because it's wild. Are you saying a financial disaster that wiped out millions of regular investors globally acted as this brutal, forceful catalyst that gave birth to a new tech empire?
Yes. The bubble artificially forced capital into the country at a rate that rational, careful economics would never have allowed. It funded the laying of massive transatlantic fiber optic cables. It built state-of-the-art server farms. Most importantly, it paid for the training of tens of thousands of engineers, coders, and project managers.
So the investors lost their shirts, but the physical stuff they paid for didn't just vanish into thin air.
Exactly. I would describe a bubble as an evolutionary forcing function. It's like a wartime economy.
Okay, how so?
During a war, a country might spend irrationally to build massive factories to produce tanks. When the war ends, the tank market collapses. The investors in those factories might lose money, but the factory's still there.
Right.
The trained machinists are still there, and they can be repurposed to build tractors or cars.
That is a phenomenal way to look at it. The equity values collapsed in 2000, the stock prices went to zero, there was a brutal V-shaped fall in funding immediately after, but the assets remained.
The fiber optic cables were still in the ground. The human capital was highly trained and suddenly hungry for work. The bubble was essentially the oxytocin for a new world. It induced the labor of a high-tech economy, even if the process was incredibly painful for the investors who funded it.
Induced the labor. That is a haunting way to look at a financial crisis. So Israel has the infrastructure laid by the bubble, they have the legal fortress built to protect investors, and the global capital has arrived. But this forces me to ask the macro question.
Which is,
Why doesn't everyone just do this? If the playbook is known, if the NBER report spells it out this clearly, why are there still rich countries and poor countries? Why doesn't every developing nation just copy-paste the legal code and invite FDI?
to understand why it's so difficult to replicate, we have to transition to the macro truth about global wealth. We have to look at how technology actually moves, or rather, how it fundamentally doesn't move.
Let's bring in the empirical data here. The report cites economists who conducted a massive analysis of 1.5 million patents and 4.5 million citations to track how knowledge spreads across the globe.
And the statistic they uncovered is profound. It completely shatters our modern assumptions.
We tend to think of the internet age as this borderless utopia, right? We think information flows freely like water. If someone in Silicon Valley writes a new algorithm, someone in a developing country can just read about it and copy it.
Right, but they can't.
Exactly. The data shows that only 9% of knowledge is learned outside its country of origin. 9%.
It is a profound geographical trap. Technology is not water. It is a highly viscous substance that sticks stubbornly to the exact place where it was created.
Why is it so sticky? Why doesn't it spread?
Because, true, frontier knowledge isn't just a recipe you can read in a book. It is tacit knowledge.
Tacit knowledge.
It is the unwritten know-how, the specific engineering culture, the informal networks of problem solving that exist within a highly specialized cluster of people. You can't download tacit knowledge. You have to be in the room to absorb it.
So if you are a developing country, you are essentially quarantined from the frontier of human knowledge. The knowledge is locked tightly inside the borders of the US or Japan or Germany. Rich countries pour massive amounts of money into R&D, and because that knowledge doesn't easily cross borders, it continuously, relentlessly widens the wealth gap against poor countries.
Exactly.
They invent new tools to get richer, and the poor countries can't access the tools.
The quarantine is absolute. You cannot break it through normal trade. As we established, knowledge flows reach much farther than trade flows, but they are still highly localized.
So how do you break the quarantine?
The only highly efficient, legally sanctioned channel to break the quarantine is our apex predator, foreign direct investment.
FDI is basically a highly organized form of technology smuggling.
That is a very accurate, if slightly provocative way to conceptualize the mechanism.
Think about the mechanics of it. When a multinational corporation, say Intel or Microsoft, sets up a massive R&D facility in a host country, they aren't just bringing capital.
Right.
They are bringing their proprietary software. They are bringing their internal, highly guarded engineering protocols. They are bringing their advanced management techniques.
They are physically carrying the R&D across the border.
Yes. They are planting it in the host country, completely bypassing the geographic quarantine. They are smuggling the future into the country.
And this deliberate smuggling creates what economists call spillovers.
How do spillovers work in practice?
It's human movement. The local workers hired at that multinational facility are trained in those advanced smuggle techniques. They learn how a world-class tech company operates from the inside.
Okay.
Later, those workers quit. They walk out the door carrying that tacit knowledge in their heads, and they start their own local companies. Or they join existing local startups, bringing the world-class protocols with them. This spillover of knowledge is the core engine of catch-up growth for a developing economy.
But I hear a massive but coming.
But this growth comes at a severe, highly localized, and very painful cost. And this is perhaps the most uncomfortable truth in Professor Razin's entire analysis.
We're getting into the hidden price, the concept of a nation torn in two.
Yes,
Because if you, listening to this, think that foreign capital brings universal prosperity, that a rising tide automatically lifts all boats, the data is about to prove you dead wrong.
we need to look closely at the data presented in the report regarding labor productivity.
Yeah.
It exposes what we call the parallel worlds phenomenon.
The numbers are chilling when you really think about the human impact. During the absolute height of the capital frenzy, labor productivity in the information technology manufacturing sector, the core tech hub receiving all this FDI skyrocketed by over 10.2% annually.
That is hypergrowth. That is the definition of an economic miracle on paper.
But in that exact same period, look at the IT services sector. Look at the local people outside that tiny elite manufacturing bubble. Their productivity didn't just stagnate. It suffered a disastrous negative 3.6% plunge.
A plunge, not a slowdown, a complete reversal.
How does that happen mechanically? How does pouring billions of dollars into a country actually make half of the tech sector go backward?
It happens because the capital injection from FDI is so specific, so demanding, and so highly targeted that it actively cannibalizes the rest of the economy.
Wow.
Let's walk through the mechanics. A massive multinational arrives. They have functionally infinite capital compared to local firms. Who do they hire?
They hired the absolute best engineers in the country.
Exactly. They offer double, triple the going salary. They violently suck all the top-tier talent, all the senior managers, all the most promising graduates out of the local labor pool.
Leaving the domestic IT services sector with what?
Leaving them with junior staff, less experienced managers, and a severe talent deficit. Furthermore, the multinational drives up the cost of everything: commercial real estate, specialized legal services, accounting.
Oh.
The local IT services firm suddenly has higher operating costs and lower quality talent. Their output drops. Their productivity plunges by 3.6%.
So we have to point out the chilling reality here. A country's GDP can look absolutely incredible on paper. The total numbers are going up. The international press is writing glowing, breathless articles about the new tech miracle.
Right.
But functionally, half the citizens in related sectors are economically drowning. The tide didn't lift all boats. It lifted the luxury yachts and created a massive whirlpool that sucked down the dinghies.
It creates an extreme duality. A two-tiered society living in the same country but experiencing entirely different economic realities.
And this duality isn't just statistical on a spreadsheet. It is geographical. It physically alters the landscape of the country. This brings us to a crucial concept: the agglomeration effect.
The physical folding of space.
Imagine looking at a heat map of Israel's wealth and productivity. You don't see an even democratic spread of prosperity across the country.
No, you don't.
You see resources, foreign capital, and the absolute top 1% of brains being violently, magnetically sucked into tight, ultra-dense urban centers, specifically the greater Tel Aviv area.
The clustering of high-tech firms, venture capital offices, and university research centers in one physical location is a deeply powerful, productivity-enhancing mechanism.
But why does physical proximity matter so much in the age of the internet? Can't they just zoom?
Because of that tacit knowledge we discussed earlier. The data shows that simply doubling the market size in these tight physical clusters yields a 3 to 8% baseline productivity boost.
That's huge.
It fundamentally alters the quality of the products being generated. When you put the best engineers in the exact same coffee shops, the exact same bars, the exact same networking events as the most aggressive venture capitalists and patent lawyers, magic happens. Ideas cross-pollinate at a staggering rate.
The spillover effect on steroids.
Exactly. It creates a self-sustaining ecosystem of hyperproductivity.
But there is a brutal downside to this geographic folding. If you aren't inside that specific geographical and educational circle, if you live in the periphery, if you grew up in a town 50 miles away, if you don't have the exact right degree from the exact right university, you are effectively exiled to a low-income, stagnant timeline.
Yeah.
You are living in the same country, paying the same taxes, but you are trapped in a completely different economic century.
This is the spatial manifestation of economic inequality. Global capital doesn't invest in a country as a holistic entity. It invests in a city, or even just a specific neighborhood within a city. The rest of the nation is irrelevant to the algorithm of capital.
Which brings us to a feeling I think almost everyone listening to this can relate to on a visceral level. Let's talk about the macro paradox.
It is the defining frustration of the modern worker.
We all feel this, don't we? Why does technology feel so incredibly advanced? We have artificial intelligence writing code, we have instant global video communication, we have supercomputers in our pockets. But everyday people feel increasingly exhausted, and average wages feel completely stagnant.
The NBER report addresses this paradox directly with cold, hard data. Look at the chart in the paper that plots GDP per hour worked,
Right.
which is the standard measure of average labor productivity from the year 2000 to 2015.
And compared to the fireworks of the R&D spending and the FDI charts we looked at earlier, this chart is pathetic. It is profoundly depressing. It's a flat line that barely, agonizingly crawls upwards over a 15-year period.
It is the visual representation of the disconnect.
The high-tech sector is experiencing a vertical 90-degree spike. The wealth being generated is astronomical. But the average output per hour, the actual economic reality of a normal worker, is essentially frozen. How is that mechanically possible? Where did all the money go?
The staggering dividends of capital are devoured by a microscopic elite. The massive gains in productivity, the billions generated by these tech exits, are captured almost entirely by the people who hold the core intellectual property, the venture capitalists who funded it, and the multinational executives holding the management rights.
It doesn't trickle down.
It does not trickle down. The global high-tech surge, driven by FDI and extreme agglomeration, simply did not translate into a macroeconomic miracle for the average laborer. The system is designed to be highly concentrated, not highly distributed.
We are so busy cheering for the grand cinematic story of a nation rising. We look at the total GDP numbers going up, we look at the billionaire founders on magazine covers, that we completely ignore the micro-individuals who are mathematically averaged out of existence.
A macro paradox is that the richer the top gets, the flatter the line becomes for everyone else, because the resources are constantly being siphoned upward into the high-tech clusters.
If we synthesize this entire deep dive, Professor Razin's NBER paper is not just an academic theory about Israel's history. When you look at the mechanics, it is the instruction manual for running a modern empire in the 21st century.
It is a playbook, a very clear, very ruthless playbook.
Let's lay out the steps of that playbook because it forms a continuous, self-reinforcing loop. Step 1. Capital crosses borders, seeking the absolute highest returns, escaping stagnant local markets.
Right.
Step 2. It demands to find genius, but it categorically refuses to invest unless it is protected by extreme legal safety, creditor rights, and the power to take managerial control.
Step 3. Once mathematically secure, it forces the smuggling of technology, bypassing geographic quarantines and creating massive knowledge spillovers in a hyper-concentrated urban hub.
Step 4. It generates unfathomable wealth for the insiders. And Step 5. It carves an unbridgeable class divide between the globally integrated elite and the isolated, stagnant periphery.
And the final, inescapable rule of this playbook is crystal clear. No country on earth, no matter how fiercely patriotic, no matter how many brilliant citizens it possesses, can lock its doors, rely only on its own people, and successfully invent the future.
It's just not possible.
Globalization, the free, aggressive flow of ideas and capital, was the absolute prerequisite for survival in the high-tech era.
But that brings us to the present day. And this is where the story takes a sudden, dark turn, because everything we just discussed is based on a world that was integrating. But today, the world is reorganizing.
We are watching the historical data unschool in reverse.
The globalized network of capital and knowledge, the exact delicate network that built the tech miracle that allowed the smuggling of the future through FDI, is currently being violently ripped apart. We are seeing a rising tide of deglobalization across the planet.
We are seeing nations frantically putting up massive capital controls, technology blockades, semiconductor export bans, restrictions on foreign investment in critical infrastructure.
The tools of integration are becoming the primary weapons in modern great power conflicts. The walls are going back up.
And if the NBER report teaches us one immutable law, it is that innovation cannot survive behind walls. The isolation death trap is waiting.
So I want to leave you, listening to this, with a haunting question to mull over. We've seen the brutal math. We know exactly how it escapes the mud of low-tier manufacturing. We know that isolation is fatal to innovation.
Right.
So if the world is actively putting the walls back up, if technology and capital are once again trapped behind national borders, and we choke off the lifeblood of foreign direct investment, what happens next? Are we currently blindly repeating the mistakes of the eve of the Great Depression. When the dust finally settles on this new, fragmented, divided world, who will be the casualty of the next lost 30 years?
The diagnosis of isolation is always fatal.
The mud of the low-tier trap is waiting. Think about that next time you see a nation promise to build the future all by itself.